Hello, I'm Jason Kelly. Thank you for joining me today. In this video, I'll show you why my signal system uses bonds for safety. In recent years, pundits have been warning against bonds. They've been saying for about 4 years now that bonds are going to crash any day now because the Federal Reserve is going to start raising rates, and you know what that means to bonds. The 30-year bond bull market is over, and so on and so on. If you want to see a recent example of this, see my video titled, Should You Avoid Bonds?, which defuses a recent warning from Bill Gross at Janus. My signal systems all use just two funds. There's one stock fund for growth and one bond fund for safety. Now that bond fund for safety is getting a lot of attention these days because people say bonds aren't safe, they're going to crash. That's what I want to look at with you today. The reason all permutations of the signal system, there are three main ones, 3 sig, 6 sig, and 9 sig. The reason they all use just two funds, the stock and the bond, different funds in each one, but each of them uses just the two types of funds. And the reason for that is it makes quarterly signals very simple. At the end of each quarter, the system compares the two funds and decides where capital needs to move between them. Built on the assumption that stocks move around a lot in price and grow more over time, bonds move around less in price and grow less over time, but are a wonderful repository for your safe buying power. So the question is, should we assume this relationship is over now? Should we follow the warnings of the pundits and get out of these bond funds and use something else like cash? A lot of people are doing that. They are fleeing bond funds for maybe something riskier like stocks or something that doesn't pay anything these days like cash. Let's look at this historical relationship between stocks and bonds. To help with this, we're going to turn to some evidence provided by Ben Carlson, who is the Director of Institutional Asset Management at Ritholtz Wealth Management. In a February 6, 2017 article on Bloomberg View, Carlson provided this table listing the 15 bear markets in the S&P 500 since World War II. All right, this is what the table looks like. We'll show it up on your screen in a second, and I'll talk you through it. S&P 500 bear market since World War II. The first one, May 1946, lasted until October 1946. The S&P 500 went down 26.6% over a 133-day period. Skipping down to a massive one, January 1973 through October 1974, the S&P 500 went down 48.2%, and that was over 630 days. The biggest recent one, of course, was the subprime mortgage crash. And you can see that second from the bottom. October 2007 through March 2009, the S&P 500 went down 56.8% over a 517-day span. At the bottom, the averages. The average percentage decline was 29.7%. And the average number of days was 345 days. Those are the 15 bear markets that have happened since World War II. Would it have been good to own bonds during those stock bear markets? The pundits are saying bonds are not the place to be. They're also saying stocks are not the place to be. Sometimes you wonder if they consider Earth not to be the place to be, but we're stuck here, right? And the two main asset classes remain stocks and bonds. How have bonds held up during those stock bear markets? Again, let's turn back to Carlson's data. His next table, it looks the same. It's the same set of stock bear markets, but the column on the far right shows the performance of 5-year treasuries through those same stock bear markets. Now, I'll show that up on your screen too, and I'll walk you through it. Again, May 1946 through October 1946, S&P 500 down 26.6%. How did 5-year treasuries do? Just fine, gained 0.4%. The January 1973 through October 1974 bear market took the S&P 500 down 48.2%. During that time, how did 5-year treasuries do? Up 4%. Up 4%. How about the massive subprime mortgage crash? October 2007 through March 2009, S&P 500 down 56.8%, bonds up 15%. You see, this historical relationship between stocks and bonds is the traditional one. It's essentially why they were created, to work together this way. You don't want to put your non-stock market capital in cash. It doesn't earn anything. So it's going to sit there as dead money for the decades that go by and the pundits are wrong about a bond market crash. Remember, the vast majority of income from bonds has nothing to do with price change. It has everything to do with distributions from those bonds. And over time, the distributions catch up with whatever the bond prices did. The bottom line is bonds are a fine place. They remain a fine place to keep your safety capital. Why are they good to have? Because when the next stock bear market comes, and it will, we all know that, we just don't know when stocks go down big time next, you can depend on your bond fund capital for buying power during those wonderfully priced stock market times. And that's what you want to be able to do. Just two asset classes, folks. Stocks for growth, bonds for safety. The relationship still works. Ignore all the bond market warnings and keep your safe capital in bonds. That's my advice for you today. Thank you for watching. If you like this video, please show that by liking it on YouTube, and I'd love to have you subscribe to my YouTube channel for more information like this. Kelly Letter subscribers, I will see you Sunday. Everybody else, have a great weekend.